Hi there. Welcome to The Open here on BNN Bloomberg. I'm Lindsay Biscaya. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Barrick Mining beat estimates on profit and revenue in its latest quarter and maintained its full-year production outlook. The mining company was helped by higher gold prices and improving operational performance, with free cash flow also climbing sharply. Barrick also announced a $3 billion share buyback ahead of its planned IPO of its North American assets. And Cineplex saw weaker than expected first quarter results as softer advertising demand weighed on performance. Revenue rose 16%, but missed analyst estimates. The company pointed to a slowdown in theater advertising, partly due to spending shifting toward the Winter Olympics and tougher comparisons with a year ago. And shares of Nintendo are falling in Japan after the company hiked prices on its Switch 2 console. Nintendo's outlook for this year failed to woo the market, with the company forecasting 16 million unit sales of the Switch 2 in the current fiscal year. That's down from 19 million since its launch in June of last year. And we're keeping an eye on U.S. futures this morning. They were all remaining steady earlier, basically flat at the moment. We're continuing to watch that for you, all really trending down ever so slightly. We're also watching the TSX today to see if it can see some gains. Of course, watching developments in the Middle East. Still no deal yet between the U.S. and Iran, and that will potentially be weighing on markets later today. S&P futures were at all-time highs earlier this morning, despite rising oil prices and a lack of a deal between the U.S. and Iran. Our next guest says the market is being driven by the AI build-out, infinite compute demand, and AI broadening to small and medium-sized businesses. Joining us now is Hans Albrecht, equity fund manager at Option Pit, and it's great to have you join us. Good morning.
Good morning, Lindsay. Thanks for having me.
So S&P futures were at an all-time high earlier this morning. What did you think about these valuations? Did you feel as though they were justified?
I mean, I think things have gotten a little bit on the frothy side of things. We've seen a very, very big move up, obviously, in the past month. A lot of that heavy lifting being done by tech, by AI, by Mag 7 or Mag 10, if you will. And so I think I think it's all based on the reality of this infinite compute demand. I think that's very much a real thing. So this isn't like the 1990s where we built all this capacity. It is very much a story of there isn't enough capacity. Google said so. They could have done even better with their cloud numbers if they had the ability to provide more service. And Anthropic basically saying the same thing. So a lot of these really, really smart companies that are very close as you can be to AI, are actually even underestimating the demand that's out there. And I believe that continues. So stocks are going to do what stocks do. The story is real. We'll have to see if we're a little bit overbought here, which I think we are.
Interesting. When it comes to your strategy for investing in the Mag 7, what does that look like? Like, how much exposure do you have right now, particularly to Microsoft and Meta? Those are the two lagging, the kind of big tech companies at the moment.
Yeah, so for the year, I've been very much long Apple, Google, and Amazon, and short Meta and Microsoft. And it's not that those are bad companies, it's just that they don't have that full stack that investors want to see these days. They want to see a number of different spokes in the wheel that are taking advantage of AI. So if you don't have a physical exposure, such as a great chip, which of course Microsoft doesn't have, Meta has one, but it's really not, it's nothing really to speak about. So if you don't have all these different pieces like a Google, they've got YouTube, they've got cloud, you're really in trouble. So we're seeing that it's a very binary market. Investors are rather ruthless these days. And if you don't have the full story, you're not benefiting from that. And of course, those three names are making all-time highs as Meta and Microsoft are well off their all-time highs. They just don't have that story. Microsoft in particular is a little bit too close to the fire, a little bit too close to that area of coding is under threat, that software as a service world, very software sort of based. And Meta really is doing quite well. But they don't have those other things. They don't have the cloud business. They don't have the physical, et cetera. And they're not getting compensated for that, even though their ad business is doing excellent.
You also say it's not NVIDIA's world anymore. It's Broadcom's. Why do you think that?
Well, NVIDIA was really the story, the one story in town for many years because they were part of the training phase of AI. So what we flipped into about a year ago was a realization that inference is much more important. So training, you kind of do it, you teach these things, you teach these AI models as people know them, ChatGPT, Anthropic's products, all these other LLMs as we call them. And you teach them. It's kind of a one and done. It does continue, but it's a bit more of a one and done. Inference is very much the gears never stop turning. You are having a conversation with AI. It is working on things 24/7, and that's a really big change. And so this whole training thing that NVIDIA has been very good at, they are doing some other things as well, is sort of moving into other chip makers, so semiconductor companies that are taking more advantage of the inference part of this phase, which is the never-ending phase, right? It just keeps going and going and going. NVIDIA is going to obviously be a very big competitor there. They're not that expensive, but they have a lot more competition than they used to. And it's a bit like Mag 7, right? You're sort of seeing they all moved up together, and now the market is starting to pick and choose. And I think that makes NVIDIA a great company, probably not overvalued, but it has a lot of competition now. For example, from Google, which we just talked about, the TPUs are very, very popular and flying off the shelves.
Oh, that's what I was going to ask you. You kind of answered it already, but like, what does that mean for NVIDIA or for investors that have NVIDIA? Still, obviously, a good stock to have.
I think it's a solid hold. I just think you're seeing evidence that it isn't leading the way it used to, right? It's sort of hasn't really done anything for about 7 or 8 months as Broadcom's come back a little bit from the lows. They're more the pieces, right? So we're seeing other parts of the puzzle really come together. The memory part of it is clearly an area where there are shortages. The kind of the web that pieces it all together in data centers, that's something that AVGO does. Qualcomm, for example, starts to get into AI at the edge, and AI in all the devices around us, in cell phones, but every manner of device around us in the world. So these things are starting to become as important, and the way that we create AI at the edge, for example, in cars, is very, very important. We can't send information to the cloud when we're driving and wait for an answer. Things have to be done immediately.
On the flip side, because we've talked a lot about some of the stocks you like. I believe you touched on Apple as well. If you want to elaborate, you can. But I also want to get to the stocks, something you're staying away from right now, and that's Adobe. And I want to hear why that is.
Yeah, so I mean, Apple, a terrific stock. I've loved it for quite a while now. I think a lot of people get down on Apple because they're not spending the hundreds of billions of dollars to supposedly, take advantage of AI. But Apple's a company, I believe, that is in the right place at the right time. They're able to wait for AI to come to them. As soon as we realize that we need the AI genius in our pocket, AI in our pocket is a very, very big theme for me this year. I think Apple's well positioned. They have a high margin product. They have a rabid fan base that is going to take advantage of that. And they're also selling a ton of Macs. Months ago, I said they're going to sell out of Macs, and that's exactly what they reported recently, because they are very conducive to agentic AI and the things that people are building now. That M5 chip is amazing. Now, to Adobe, that is the complete flip side of the coin here. That is the world of abundance, in the sense that coding is now an area that has no barriers to entry, right? Anybody can become a coder. And so that was really a barrier to entry for 20 years, for 2 decades. Software as a service was a wonderful, wonderful business. You build it, you sell it 1 million times to people, and they pay every single month. Now anybody can code. And I know it's oversimplifying to say that, hey, I can create a Salesforce tomorrow. That's not realistic, but the writing's on the wall. And so now as people look out 4 or 5 years or even beyond, they can't make the same sorts of calls that they did a few years ago, which is, hey, I see 15, 20 years of cash flow from this company. We just don't know where Adobe is going to be in 3, 4, maybe even 2 years. And that uncertainty, as you know, Lindsay, is not something that markets like. So they're shoot first, ask questions later, and it's, again, very binary market.
Yes, already have a lot of uncertainty in the markets as it is anyways. Okay, we'll have to leave it there. Hans Albrecht, Equity Fund Manager at Option Pit. So great to have you this morning. Thanks so much.
Thank you.
Coming up, we will tell you about the setback for some farmers in Saskatchewan due to severe flooding in the province there. Stay with us. That's next. Some farmers are back in their fields in many parts of the prairies, busy planting this year's crop. But for others in flood zones across Saskatchewan, it could take weeks before they start seeding. Another setback as producers already struggle with the high cost of fuel and fertilizer. CTV's Alison Bamford has more on the triple threat.
A lakeside view that would almost be serene if it wasn't in the middle of the Hoey family's field.
This was technically pretty much all seeded last year.
Normally, Joel Hoey would be in the field by now, planting this year's crops. But floodwaters are pushing back his timeline at least 2 to 3 weeks.
We're not anywhere close. It is what it is, but at the same time, it's really just starting to eat away at your bottom line.
Last year, this entire field was wheat. Hoey and his family were hoping to plant peas here this year. Likely not going to happen now unless all of this water recedes in a hurry.
Rising price of fuel, the high cost of inputs, and then you got this situation that we have starting later. It's a real kind of a bummer.
The area and dozens of others are under states of emergency, leading to seeding delays across the province.
Later seeding just will likely translate into lower yields.
That is, if some crops are seeded at all. Farmers have until mid-June to plant their crops in order for them to be covered under insurance.
I'm pretty sure there's going to be quite a few acres going unseeded this spring just because they're just too wet to get into in a timely basis.
Even when things dry up, flood-damaged roads will make it hard to get heavy equipment anywhere. But there's reassurance from Saskatchewan's agriculture minister that road repairs will be a priority.
We're going to try and work as quickly as we can. Obviously, you got to wait till the water's gone.
It's not the start Hoey wanted, but he's not writing off the year just yet.
We're doing all our due diligence to get everything ready to go.
Hoping for a smooth season once seeding gets underway. Alison Bamford, CTV News, near Paddockwood, Saskatchewan.
Fuel prices are looming over a favorite Canadian summer activity, and that's boating. With many bracing for what could be a choppy season on the water, and as CTV's Heather Wright reports, some are rethinking their summer plans altogether.
Wet weather and high water have meant a slow start to the season at Kawartha Lakes Marina in Bobcaygeon, Ontario. Boats are being launched, but marina owner Chad Hinton says some clients are considering skipping this summer.
We have a few people that are on the fence about whether or not the boat may go in. Fuel prices and general cost of living.
Nationally, the average price of gas is hovering around $1.90 per litre, according to the CAA. 1 year ago, the national average was 131.8 cents a litre. The price of fuel at marinas is already higher than gas sold in town, and so what is an expensive hobby is becoming even costlier. Hinton says the price of gas won't stop many from getting out on the water, but it will force some to rethink their summer plans.
For the family of four that saves enough to go away for a week on vacation every year, if groceries have gone up and fuel has gone up, they definitely change what they're doing on vacation.
The cost of boating depends on a number of things: the size of the boat, tank size, speed, wind. And so while some are choosing to keep their boats in storage this summer, others say they will get out on the lake but make adjustments in other areas in order to save some money.
Barclay Elliott's boat is his cottage, and while he has no plans to keep it tied up this season, he is mindful of the high cost of gas.
What it may do is, instead of 10 trips, I'll do 9.
According to Transport Canada, more than 12 million Canadian adults participate in recreational boating each year, an industry that contributes roughly $5.6 billion to Canada's GDP. But the high cost of living and soaring gas prices could further impact an industry already experiencing uncertainty. Murray Hadfield sells boats in the Kawartha area where clients have been forced to drastically reduce their prices.
They started advertising OBO, or best offer, and they still couldn't get action in the fall.
While gas prices might not soon return to where they were last summer, there is some hope that they will start to come down before this boating season is over. Heather Wright, CTV News, Bobcaygeon, Ontario.
When we come back, we will hear why Carlyle Group's head of global research and investment strategy, Jason Thomas, is optimistic about corporate earnings despite the risks facing global markets. That's next. Stay with us. Carlyle, head of global research and investment strategy, Jason Thomas, says companies have been unfazed by the many challenges facing the global economy, and he's seeing a lot of optimism in many corporate outlooks. For more, we got perspective from him in a Bloomberg interview from the Milken Institute Global Conference last week. Take a listen.
Story of the first quarter has been the extent to which the concerns about the conflicts, the potential shortages, the rise in fuel prices has not really fazed management teams. They have been through so much over the last 6 years, the pandemic, the supply chain crisis, inflation, rate shock, tariffs. And I think they've become extremely good at remaining focused on the business and driving results. I think the other big story of Q1 is very much the AI strategies. You know, for a period of time, it was a lot of AI was productivity sapping because management teams had to take a step back and look at how these new tools could be integrated into workflows, into work streams. And now they're at the point where they're actually implementing those strategies. Spending on IT budgets was up about 28% in the first quarter, according to our data. So I would say that the private markets, it's just that focus on execution. It's ignoring the noise. It's not worrying about the headlines. And of course, I think some of the lessons of 2022 are to make sure that you have all the supplies, the inputs that you need. Don't assume it's going to be available in the future.
Are you surprised by the resiliency that we've seen in economic growth? I mean, particularly, we've got those numbers obviously for 2025 and even coming in now for what people are expecting in 2026. I mean, some of the expectations are pretty bullish. I mean, we had Rick Reeder on earlier. He's talking about 5 to 6% nominal GDP growth.
Yeah, I think that, and you do see, of course, the earnings growth, public and private. And there is a sense of optimism. Now, again, the longer the conflict goes, the greater the likelihood that we're going to deal with shortages of refined products. When you think about petrochemical feedstocks, the potential to actually have shortages of plastics. So those are parts, packaging. So there are a lot of risks ahead. But in terms of the underlying trend line, it's very positive. And I think you see that at the conference, a lot of optimism about economic growth and earnings.
A lot of the optimism here is also about AI, and I mean that in the broadest of the sense. Absolutely. I mean, we've gone from just, the picks and shovels buying chips phase to how this sort of gets integrated into almost every company, almost every industry. And the optimism you hear there, you talked about it before, saying how, it was productivity sapping, but now everybody's talking about how it's increasing their productivity.
That's right. And I think that these are different stages. Initially, particularly on the private equity side, when you have a financial sponsor, that you're pressuring the companies to make sure that they stay at the edge of the technological frontier. So use AI. But when you have new tools, you have to, of course, figure out how to use them for your specific business. And that, I think, was a period of time where they had to take a look under the hood, figure it out. Today, we're at the execution stage. And that's very important because the AI story thus far has been really about the CapEx, data center investment. Now I think it's transitioning to actually the company implementation. And I would say that the chief technology officer, the chief information officer of the companies has become, in many cases, the most important person at the organization, central to the strategy going forward. And I think that's what's really exciting. We're going to see enormous productivity gains, particularly on the private side, again, where there's more pressure and the longer lead times in the next 5 years.
It's funny you say that. I was at a luncheon with a particular asset manager. Their president, the CEO, chairman are all there, the CTO. And guess who got the most questions? Exactly. The CTO.
Exactly.
I am curious about just sort of the structural changes going on right now. We talk about AI potentially being a tailwind for the economy, but obviously a transformative one. That's also going to require a little bit more of a rethink of public policy, whether it's fiscal policy, monetary policy. Kevin Warsh has talked about this a lot in his confirmation hearing, just having to rethink how you assess inflation in this type of environment. Are you doing that also from the investment side right now?
And I think what's interesting is that there's a need to separate today from tomorrow. What I mean by that is today, AI is actually having upward pressure on inflation. I think in two important respects. First, just the scale of investment is actually taxing economy-wide resource constraints. This isn't just energy and electricity generation and related infrastructure, but just the scale of investment. It's almost the entire addition on net to the capital stock is related to AI data centers. And so again, upward pressure on the price level inflation. Secondly, a lot of the AI tools are empowering management teams to be more aggressive in their pricing. You're learning more about your customers and their switching costs. You can do real-time experimentations with prices on different products, services you sell. And so that's a really interesting dynamic. Now, tomorrow, in the fullness of time, this will be hugely disinflationary. I think we can all see that. And as it relates to monetary policy, it is just how do you get it right? How do you balance this today, perhaps inflationary pressures, but we know what's coming tomorrow.
I do want to get your thoughts on what's going on outside of the U.S. About a year ago, amid all the tariff turmoil, there was all this talk about people quiet quitting, investors quiet quitting the U.S., looking for more geographical diversification. I think we're still seeing that, but I am curious from your lens, are you still seeing, and I'm talking about U.S.-based investors, looking a little bit more towards Europe or even to Asia?
Yeah, absolutely. And I think that from an external investor perspective, I think they have differentiated between the U.S. public and private sector. For a long period of time, the net inflows to the United States was the acquiring Treasury securities. Today, it's actually primarily stocks, corporate bonds, and of course private markets. So that's been interesting to observe. But from a U.S. investor perspective, I do think that the valuations are much more attractive. There was a period of time where people were pivoting out of tech, concerned about excess exposure to it, just the fact that all of the data center investment, other areas had consumed all of their incremental risk budget. And so whenever you're actually wanting to lighten up on tech, it also naturally leads to lightening up on the United States, looking for some better value elsewhere in the world.
Friday on Market Call, we were joined by Darren Sissons. He is partner and portfolio manager at Campbell Lee and Ross Investment Management, and he was covering global and technology stocks. These were his top picks: Accenture, PSL, Alphabet, and the S&P Global. Today on the show, we have Ernest Wong. He is head of research at Baskin Wealth Management, and he'll be taking your questions on North American large caps. So be sure to tune in noon Eastern time. And before we go to break, we're going to take a quick look at U.S. futures as we count down to the opening bell. Stocks seem to be wavering this morning as the Iran deadlock lifts oil and yields instead. After a record run last week, the S&P down by 0.1% at the moment. The Dow future basically unchanged. The NASDAQ down also by about 0.1%. If we take a look at oil on the flip side, as I mentioned, it is climbing today as the Strait of Hormuz remains shut. Oil up by just over 1% at the moment. Brent advancing as much as 4.6% this morning. And then, of course, on the flip side, we're watching gold, price of gold falling as Tehran says the U.S. continues to have, quote, unreasonable demands. The latest from the Middle East is kind of fanning inflation fears here, which is why we're seeing the price of gold. It was down earlier. Now it's up by 0.2%. So we'll continue to watch that for you. The loonie, meanwhile, flat as higher oil prices kind of steady the currency here. You can see it's basically unchanged at the moment. And then we're also watching Bitcoin. It is stalling this morning. Smaller cryptocurrencies are gaining, but Bitcoin was stalling earlier. Now it's up by 0.5%. Investors are looking ahead to a bill that would regulate the crypto industry, and we're seeing that reaction today when you look at the price of Bitcoin, still at just above 81,000 at the moment. Stay with us. The opening bells are next. Here are the opening bells at the NASDAQ. Wise is ringing the opening bell at the New York Stock Exchange. Eli Lilly in celebration of its 150th anniversary of founding. And the TSX Middlefield is ringing the opening bell today. It's time now for the first 15. This is BNN Bloomberg. Trading just getting underway this morning, and we're keeping an eye on the equity markets, including the TSX. We're watching closely to see how everything is going to perform today. The TSX starting the day up ever so slightly, 0.3%. Not the same story for markets in the U.S. They appear to be trending down at the moment. Given the conflict in the Middle East, it seems as though no resolution yet. Oil prices are higher. Stocks are lower this morning in the U.S. We're keeping an eye, though, on some Canadian companies today. Barrick Mining is one we're watching closely. It's posting a drop in profit in the first quarter compared to the previous quarter. The Toronto-based company has also authorized the repurchase of as much as $3 billion worth of its shares. And Barrick Mining starting the morning up more than 3%. We're going to be discussing what's happening with Barrick Mining a little later today in the show. Also watching Cameco today. This company has cut activity at its mill in Key Lake and its McArthur River mine after some major flooding in northern Saskatchewan. The company says it does not know when normal transportation routes will resume, but it has not changed its consolidated annual production plan, at least for now. But because of these cuts or this pause, I guess, in production, Cameco down at the moment almost 3%. And we're also watching Aritzia. Aritzia has been given the green light to by the TSX to buy back 5% of its common shares over the course of a one-year period. Aritzia, of course, reported first quarter earnings last week. You can see up ever so slightly right now, not really much, up 0.3% at the moment to start the week. And in the U.S., we're keeping an eye on some U.S. companies, of course, today, too. Constellation Energy is one. It beat estimate earnings, but investors are weighing a first quarter earnings surprise against a full year guidance range that was centered below expectations. So we'll have to see how the stock price for Constellation Energy fares throughout the day. Markets remain on edge as investors continue to weigh geopolitical risks, shifting policy expectations, and the durability of corporate investment. Our next guest says we're at a turning point in the cycle with reasons to stay constructive, but also selective. Joining us now is Brian Vendig, Chief Investment Officer at MJP Wealth Advisors. It's great to have you join us. Good morning.
Good morning.
So you say we are at a pivotal juncture in the markets. Why do you think that is?
Well, I think last year, with all the stimulus that was passed, that we were expecting as a growth accelerator for this year, was really a cushion over the last several weeks to help us get through this conflict from an investing point of view, and that was also based on the backs of strong earnings that have really helped to support the market price right now. But really, we're at this pivotal point because the narrative still is very dominant around tech, and tech being that earnings driver, moving forward, and this CapEx trend that companies have gravitated to. But at the end of the day, we're starting to see some cracks show up on the consumer side, concerns about growth and inflation if the conflict continues. So we're kind of, I would say, at this pivotal point because I think investors are optimistic that there's going to be resolution, but if that resolution drags on longer, then that's going to impact growth expectations. And we also have midterm elections around the corner as well.
Mm-hmm. Yeah, because when we're talking about these, big AI infrastructure stocks, if spending were to slow down at any point, like what kind of challenges could that pose?
Well, I think that's the key point. If spending does pull back, then there's a concern that it's going to impact adoption on AI, impact productivity, because when you look at margins on an overall basis, weighted basis for the S&P, margins are up about 20% year over year. Even weight basis about close to 4.5%. These are very robust numbers, but the pullback in that spending for tech and how it's played out across margins and profit expansion, that then starts to bleed into a lower growth story moving forward, especially when you look at 2027 earnings outlooks right now, increase of 15% year over year. That's a little bit lower than where we are for 2026. So these are the critical things I think to keep an eye on, is that the fundamental earnings story is what's helping us support price, even though that forward PE multiple is coming down.
Something else we're watching for, the U.S. government has started processing those tariff refunds, roughly $100 billion of tariff refunds starting to be distributed out. How will this maybe affect companies and continue spending in the future, or will it really?
Well, I think it's a little bit more of that psychological planning point. I think there's a softer side to this where companies saw, last year tariffs being a net tax increase in 25. And to your point, this year it's a net tax cut with that $100 billion starting to flow through over the next several months. So I think, planning for business supply chains and so on, that's really where, trade policy has shown to be disruptive and actually has caused companies to hold back on labor hiring and then some critical decisions. So I think investors are also keeping a strong eye out for progress on these talks this week with U.S. and China, with President Trump's visit to China this week, and just seeing how those conversations go on trade as well.
Yeah, we haven't talked about that this morning yet, in this show at least, but obviously that's something we're watching for, those meetings happening on Thursday. What are you watching for? What are you expecting that maybe could benefit companies over here when it comes to those talks between the two sides?
Yeah, definitely. I think it's three major points. Number one, how much is China now going to be involved with potentially helping the U.S. for an off-ramp with the Strait of Hormuz, being that China is very dependent on energy and oil supply out of the region. That's number one. Number two, does the U.S. have some leverage in negotiating for rare earth metals in exchange for agriculture? I think that's kind of interesting, and I think that also plays back to the general commodities market on a bigger picture perspective, because the investment in the industrial cycle is definitely something where we're starting to see that China's having a little bit of an issue there, while it's a little bit more robust in other areas around the world. So how does that affect commodity demand? Playing that back to the Canadian market, but also, other type of natural resource economies around the world.
Okay, so let's get to some of the sectors you like and that you're picking today. We'll start with commodities because we were just talking about that in a different sense. But you say you do like commodities as a hedge. Which ones in particular are you really bullish on?
Yeah, so I think the commodities market right now, when you think about trade and policy, we've really seen around the world that countries are using natural resources as a means to negotiate some of these policy decisions. So when you play that through, I think in industrial metals, agriculture, of course, oil, natural gas, and a little bit of gold are areas that we're focusing on as a hedge for some of these geopolitical or policy risk issues. But also, we also believe that coming out of the conflict in the Middle East, can expect a weaker dollar, which also helps to support price for commodities as well.
Mm-hmm. Well, I'm looking at oil in particular. Obviously, we're seeing higher oil prices once again today, given what's happening in the Middle East. How long do you expect those prices to maybe stay elevated for? I know I'm kind of asking you to predict the future because we don't know when this conflict's going to end. But also, you mentioned in your notes that kind of removes the rate cuts that we might have seen from the Fed later this year.
Yeah, I think the concern about energy price and the demand destruction on the consumer and also the higher inflation is why I think right now, with a good profit backdrop, the Fed is on pause until late 2026 for a rate cut. We still think there's possibility for one cut in the cards. But I think as it relates to energy prices, if we do see an off-ramp, a constructive bullet point path to have a peace deal, then we do expect overall oil prices to come down. But when you look at the forward futures market, and trying to do my best in predicting the future, we see that those prices are settling kind of in the $70 to $80 range. And that seems to be the right point from a demand supply point of view, because supply chains have been disrupted. And it's going to take a while, months for many of the oil exporters to really get back up online. In some cases, for natural gas, it might even take a few years. So expect elevated prices. It's going to push up some of those inflation expectations for the Fed. But at the end of the day, with demand being so sensitive to price, we do see inflation over time coming down due to a slowing economy.
Okay, we're going to have to leave it there. We're out of time. Brian Vendig, Chief Investment Officer at MJP Wealth Advisors. Thanks for your time. Appreciate it.
Great to see you. Thank you.
Thank you. Up next, we are watching shares of Barrick Mining today after it beat estimates on profit and revenue in its latest quarter and maintained its full-year production outlook. More on that after the break. Barrick is starting the year on a strong note, beating gold production expectations and generating a sharp jump in cash flow and earnings. At the same time, it's pushing ahead with a North American IPO expected to be complete by the end of the year. Let's get more now from Lawson Winder Metals and mining analyst at Bank of America Global Research. It's great to have you join us. Thanks so much.
Thank you. It's great to be here.
So what stood out to you most about the company's operational performances in this quarter?
Well, look, I mean, the beat that they had today, which was a beat, earnings and adjusted EBITDA were both well above our and consensus expectations, was effectively driven by sales that were far better than expected, sales volumes. But production was also a little better than expected, relatively in line with us, but ahead of consensus expectations. So production-wise, it was a solid result. Guidance-wise, it was fairly solid as well. So they guided to Q2 production that was quite a bit above where consensus estimates are as well. So the midpoint of that guidance would be sitting above where we were and where the Bloomberg consensus estimates currently showing right now as well.
The CEO in the release was repeatedly emphasizing safety. Why do you think that's such a focus right now for the company?
I think it's a focus for the industry as a whole. I mean, if you look historically at the mining industry, safety has been problematic at times throughout history, and I think the whole industry is just focused on improving safety records, and I think it's really important. It's important for investors, but it's important for obtaining social license. I mean, if you're going to operate in a country, I mean, you want to have a strong record on safety in order to earn that social license from both governments and local communities.
Yeah, good point. I mean, also gold prices, they're very strong at the moment. They're down a little bit this morning, but still pretty strong. Clearly, that might have helped earnings and cash flow for the company, but how much of the latest quarter for Barrick do you think was based on execution rather than actual just higher gold prices?
Yeah, that's a great question. So sometimes with these earnings, you'll see realized gold prices that do deviate from what the average was in the quarter on a spot basis. So in this case, they were relatively close. In this case, this truly was an operational beat rather than just a benefit of gold prices. But to your point, I mean, gold prices last year were up phenomenally. It was one of the strongest years for gold on record. And so there's no question that that's helping. And so you saw a very strong free cash flow result today. And the other thing you saw with Barrick is, they didn't buy back any shares in Q1, but in Q1 they did announce an enhanced dividend program. So what they've done with results today is they said, look, we are going to buy back shares now going forward. So what they've done is the board has approved a $3 billion buyback. And so that would be in addition to the dividend. And I think that reflects operations. But to your point, I mean, there's a reflection of very strong gold prices in that.
Yeah, and I do want to talk about the share buyback in just a moment, but just staying on those higher gold prices, if there was to be a pullback in gold prices, how much do you think that might affect Barrick?
Look, it's a great point. I think it will affect Barrick, but it'll affect the entire industry. I mean, a pullback in gold prices would certainly reduce the amount of free cash flow they have available for buybacks and investing in operations. But the way we look at it is from here, given where gold prices are relative to costs, you would need a very significant pullback in gold prices before it actually became a problem for their ability to at least return some capital to shareholders and, importantly, maintain the current dividend. And we see that across the industry, too. It's not just with Barrick, but I mean, the current dividend levels relative to the margins on gold price versus industry costs are very robust, meaning the risk of those dividends being negatively impacted are very, very low. You need a very significant decline in gold prices for that to happen.
Got it. Okay, so let's talk about that share buyback program now. Barrick announced it today, $3 billion in share buybacks. Do you think management is signaling here that the market's not fully valuing the North American assets with the broader company today, or what do you think this whole move signals?
Yeah, I think that's a completely fair statement that you've made. I mean, I think the language in the release speaks to a recognition that their shares on a relative basis are trading at a discount to peers. And our numbers show that's the case as well. I mean, Barrick on EV/EBITDA, on free cash flow yield, on price to net asset value, on our numbers is trading at a discount relative to its larger peers. So I think there's some merit to that statement. And the company is reiterating exactly that point.
I also want to talk about copper, because copper production for Barrick rose 11% year over year. Copper costs also have increased, though. How do you view the strength of Barrick's copper business side right now, especially as demand for copper continues to grow globally compared to the gold side?
Yeah, I think it's a really important component of the Barrick story. Copper offers exposure to a really important investment theme today, which is electrification. And there's a lot that goes around with that. And having that copper exposure is really important. I think Barrick recognizes it. So one feature of today's results was an update on the Lumwana expansion project. So that's their copper asset in the Central African Copper Belt. So it's in Zambia. The update was good. Things are on track. They're still tracking towards a Q1 28 first production of expanded copper production. I think it's a really important part of the overall Barrick story.
4 Mile also being talked about as a future tier 1 gold asset. Lumwana advancing towards first production in 2028. How crucial do you think these two operations are in the growth story for Barrick moving forward?
Look, 4 Mile is an extremely important part of the overall story. So there's an asset they own 100% of. It's not currently within the Nevada Gold Mines joint venture. And so Barrick would have the option to put that into the Nevada Gold Mines joint venture for purposes of processing the ore. it's also a deposit that's grown by leaps and bounds. I mean, and not to understate it. I mean, it was discovered within the last decade, and today you're talking about a deposit with multi-tens of millions of ounces with upside potential and very, very strong grade. So really important part of the overall Barrick buy thesis. And if you just look at how the shares performed in September around a site visit that they held to 4 Mile, I think that share price reaction speaks to the excitement that the market sees in 4 Mile and the upside potential there.
Okay, we're going to have to leave it there. That's all the time we have. Lawson Winder, metals and mining analyst at Bank of America Global Research. Appreciate your insight today. Thanks for joining us.
Thank you.
Just ahead, we will get the latest on 4 Canadians who are isolating in British Columbia and dozens of passengers still on board a cruise ship that was stricken by a deadly Hantavirus outbreak in the Canary Islands. Stay with us. Okay, we're going to go now to the latest from the cruise ship at the center of a deadly hantavirus outbreak. 4 Canadians who were on board the vessel are now in isolation in British Columbia after being flown home on a chartered flight. And for more, we are joined now by CTV's Annie Bergeron-Oliver. Annie, good morning. All the Canadians who were exposed to the hantavirus, they're now back home, designated asymptomatic and in isolation. So how encouraging is this news?
Hi. Well, exactly. So that's what we know so far based on an update yesterday. And Bonnie Henry, who's the Chief Medical Officer of Health in British Columbia, is expected to be providing an update today around 2 o'clock. So we should know a bit more later this afternoon. But as you said, these Canadians are now off that cruise ship. They're back on home soil. They have been flown to British Columbia, where they're going to be under a period of isolation for 21 days. We're being told that they're going to be checked on daily by trained medical professionals, screened to ensure that they don't have symptoms. And if they do have symptoms, health officials there in that province are saying that there is the ability to move them to Surrey Memorial Hospital, where there's a designated team and unit for quarantine. So yesterday, Bonnie Henry, the medical officer of health in British Columbia, said that the risk to the public is very low, that these 4 Canadians will have no contact with the public and have not had any contact with the public. So that's what we know so far about them. We also had an update from the health minister in Ontario not too long ago. She said 2 individuals in Bruce Grey County, so sort of, north of London, they are currently isolating as well for 21 days, currently have no symptoms. But she did say that a 3rd person in Ontario in the Peel region is currently also under isolation and being checked up by public health officials, though they say right now this individual also has no symptoms. So we don't know too much about that individual or how they're connected. This information is just developing today. But what's clear is that health officials here in Canada are taking this very seriously, ensuring that there is this isolation period, because the hantavirus does have an incubation period of anywhere between 1 to 8 weeks. So it's quite long, Lindsay.
Yeah, quite long. And given all of that, how certain are medical officials that this deadly outbreak has actually been contained?
Well, the WHO was on site yesterday in the Canary Islands as these evacuations were underway. And the WHO, the head of it, was saying that this is not COVID, though he said he does understand the trauma that many people around the world face, when you talk about contact tracing, when you talk about masking, when you talk about this type of a virus. So the WHO is trying to reassure people that the risk to the general public is low. They believe, from all the information they have currently, that this is an outbreak that's contained to those specifically who were on the ship, who had close contact with 2 individuals, 2 Dutch people, a couple who supposedly came in contact with a rat who had this virus in Argentina when they were potentially bird watching. So the WHO and others are saying that they believe, from all the information they currently have, that this outbreak is contained. But of course, they are doing everything possible to limit the number of contacts, to ensure that those who did have any contact with patients on the MS Hantavirus or anybody related to those initial Dutch passengers, that they are being isolated and followed up to ensure that this doesn't spread. But they are saying that for now the risk is very low, that although this Andes strain of the hantavirus does have the ability to go from person to person, they say that transmission route is extremely rare. Lindsay?
Okay, we'll leave it there. That's CTV's Annie Bergeron-Oliver joining us live this morning. Annie, thanks for the update. Appreciate it. Coming up, the AI boom has fueled demand for energy, including renewable sources like solar, but that doesn't mean investing in solar stocks isn't without risks. More on that after the break. The The AI boom has fueled demand for solar companies, but investing in solar stocks has been anything but easy. BNN Bloomberg contributor John Ehrlichman joins us this morning with more on that story. John hosts the Ticker Take investing channel on YouTube. John, good morning. So give us a bit more on what's happening in solar right now and why it's not easy to actually invest in.
Well, because there's, it's fascinating, Liz. You've got two stories going on. You're right. The demand for a lot of solar companies is through the roof right now, because not only do you have utilities that are facing more power demand, and, solar companies over the years would create this opportunity for solar farms to offer a more sustainable source through utilities. But now you've got all of these AI giants, these technology companies that are spending massive amounts, Amazon, Microsoft, Alphabet, to build out data centers over the next few years. And they are looking for power sources. And in some cases, they're looking sources like nuclear. Obviously, you guys have been covering that story. But they're also building their own solar farms. The problem for investors is that solar as an industry to invest in has always had a number of other factors you have to consider. So I wanted to highlight First Solar as an example. Now, keep in mind, this is a stock that had a great run in the second half of last year, but this year it's been a little bit more mixed. And that is in part because there's other considerations out there, whether that is the fact that all of these companies, even if there's great demand for the solar panels that they build for solar farms, have to deal with some of the input prices. Tariffs have complicated that. There's a whole tax credit system around the solar industry, which is also slightly complicated. And there's competition from the likes of Chinese players in this sector. And then there's competition even just parallel to solar from fuel cell technology. Some people may have watched Bloom Energy shares surge this year. They signed a huge deal with Oracle. And so you sort of got slightly similar but competing technologies all trying to feed into these big technology companies. So there's a lot for investors to digest when it comes to actually buying the stocks. But solar demand is expected, Bloomberg just put out a report today, is expected to be absolutely massive over the next few years.
Yeah, and just quickly, John, which stocks do analysts like the most based on all of the moving parts here?
Yeah, I took a look on Bloomberg today at the one that currently has the highest rating amongst analysts. It's a company called Shoals, and basically what they do is they help to wire up those solar panels to the battery technology. And one of the reasons analysts like this stock is they just have a lot of predictability right now in where their business is going. Overall, there's still generally some strong demand for the solar stocks on Wall Street, but investors should potentially be ready for some ups and downs.
Okay, John, thanks for that. Appreciate it. That's John Ehrlichman, and you can find John's Ticker Take episodes on YouTube and all podcast platforms. Coming up, we'll look at how the markets are responding to the latest moves on oil after this. Stay with us. Hi there. Welcome to the second hour of The Open. I'm Lindsay Biscaya. Let's take a look at some of the stories we're following in the BNN Bloomberg newsroom for you. Shares of Barrick are up this morning as the mining company beat estimates on profit and revenue in its latest quarter. The mining company was helped by higher gold prices and improving operational performance, with free cash flow also climbing. Barrick announced a $3 billion share buyback ahead of the planned IPO of its North American assets. And shares of Cineplex are down after the theater company saw weaker than expected first quarter results as softer advertising demand weighed on performance. Revenue rose 16%, but missed analyst estimates. The company pointed to a slowdown in theater advertising, partly due to spending shifting toward the Winter Olympics and tougher comparisons with a year ago. And Cameco says flooding in northern Saskatchewan disrupted transportation routes to two of its major uranium operations. It forced the company to temporarily halt production at the Key Lake mill and scale back activity at the McArthur River mine. The company says flooding caused the collapse of the Smoothstone River Bridge, a critical supply link servicing both sites. And we're watching the TSX today, see if it can continue those gains that it saw to end the week last week, above 34,000 points this morning, up 0.5%, I guess, at the moment. We'll continue to watch that for you. Also watching U.S. markets today. Stocks here seem to be wavering a little bit after news that the war in Iran maybe not ending as soon as some investors might have hoped. S&P 500, Dow Jones, and the NASDAQ basically unchanged at this point. And as you're looking at, U.S. markets are having a mixed reaction this morning as the price of oil climbs following President Donald Trump's rejection of Iran's latest proposal aimed at ending the war in the Middle East. And for more on market reaction and the latest wave of corporate earnings is Laura Lau, CIO of Brompton Group. It's great to have you join us this morning. Thanks so much.
Thank you for having me, Lindsay.
What are your overall thoughts on what we're seeing on this Monday morning with the markets, and given that it looks as though the Strait of Hormuz maybe is not going to be opened as quickly as some might have thought it would be?
So it feels like the market is, very optimistic that the Strait of Hormuz will open, but it's not an easy thing to open the Strait of Hormuz. Basically, in Iran, there's still a question who's the leadership, who can make decisions, and their demands are actually quite far away from what the U.S. and Israel want. So Iran wants sanctions to be removed. They want their assets to be unfrozen. They don't want to be attacked anymore. But they have given in some things. Like, for instance, they have been willing to give up some of their enriched uranium. And with on the U.S. side, we're not quite sure what he wants. He does want the Strait of Hormuz open, and he does want this war to end. You can see that the ceasefire hasn't really held very well. There have been, drones, bombings, other things, and still Trump has just, blockaded the strait. So it does feel like he does want this war to end. He's not, hasn't been escalating it anymore, but it seems like the two are very far apart. And the Iranians just talked today about having submarines patrol the Strait of Hormuz, bombing ships. So certainly their rhetoric has gone up. So there are concerns, when will the Strait of Hormuz open? And the Iranians know how the election cycle works. They know that $4.50 a gallon gasoline is starting to, be politically damaging to Trump. So with midterms coming up, we do think that Iran's going to keep on putting the pressure on. And as a result, oil prices are up today. 110 Brent would be the pain level. We're not quite there yet, but certainly we could get there if the strait continues to be closed.
And obviously what we're seeing today in terms of market reaction is probably more so because of what's happening in the Middle East, but also we've got a lot of earnings reports pouring in once again, which could be affecting the markets too. And I want to get to some of those with you. Barrick Mining reported earnings today, pretty strong earnings, but also announcing the share buyback program. So actually a couple big announcements coming out of Barrick Mining. What were some of your takeaways that you saw?
So the good thing is it does feel like their operations are getting better, especially in North America, and that's where it's going to be spun off. A little weaker in Africa, but, to be honest, everybody knows that Africa is difficult for Barrick, and that's why they want to spin out this IPO. And it should likely be done by year end. I'd say that, the strategy is a little confusing. The last quarter, they increased the dividend to 42 cents. Now they put it back down to 17.5, and now we're going to do share buybacks. So that is a little confusing. What is your strategy going forward? But it is good that it looks like the operations are starting to stabilize, and I think the market's really looking forward to their new discovery 4 Mile and trying to figure out how they can monetize that, considering they have a lot of infrastructure there. And the other questions also that the market's been waiting on is their partner there at Newmont. How are they going to cut costs and optimize their Nevada operations?
Another one, Cineplex, missed revenue forecast in the latest quarter. What are your thoughts on Cineplex? The shares are down right now more than 5%, so it seems investors not exactly, more than 6% actually. Investors not really happy with what they're seeing here. What are your thoughts?
Well, the good news is, people going to the movie theaters are spending more on concessions, tickets. The thing is, as you said, advertising is down. So that's not good. But Q1 is always difficult for theaters because Q1 is typically the weakest quarter for theaters. Usually the movie slate is the weakest, and usually the best is summer and certainly Christmas time. So that, I think, is actually more important, and we should actually be looking at the movie slate. How strong is that? but it is concerning that advertisers are not really putting money here.
And also Constellation Energy reporting revenue and EPS beat. Market's still waiting for another detailed announcement. What are you watching for there?
So it's good that the operations are going well. I think two things to watch for is, number one, are they signing any more deals, whether it be with hyperscalers, because they've signed some great deals in the past at above market rates. They are the largest independent power producer in the U.S., and we know that we need more power in the U.S. to power data centers. So we know that they are in discussions. So this will be very interesting to watch. The other thing is they'll be refurbishing 3 Mile Island, and we'd like to know what are the costs. Are there any cost overruns? So that would be the other thing to watch, and also timing delays.
Timing delays. Okay. I also want to get to your stock pick today, and that is Chartwell Retirement. So tell us why you like Chartwell Retirement.
So right now there's been a lot of buzz about AI, is it sustainable? So I tried to choose something that it doesn't matter what happens to AI. So what this company is, Chartwell, it's senior housing, senior living, and they tend to be mid to high end. So the big thing is demographics. So 80 plus, that's typically their target market. That demographic is growing at 4%. However, we see that the new builds are only growing about 1%. Therefore, you have pricing power. And what we're also seeing is they're also, getting a lot of ancillary services, not just, the rental, because typically what we've seen is definitely after COVID, they're a little older, the seniors a little more fragile, so they need a little more help. And with that, there's more service revenue. So the other thing we've seen is the net operating income, which is a key driver of real estate. Their net income growth was up 16%. That's great for a sleepy real estate company. And if you adjust it for the same property sales, much like same store growth for retail, that's up 9%. They also just entered a joint venture partnership with Fengate to buy 30% ownership in a portfolio of 23 senior housing communities. That's branded Seasons. And that's undergoing lease up. So there's vacancies, and they're going to lease that up. So we are very excited about that as well.
Okay, we'll have to leave it there. We're out of time. Laura Lau, CIO of Brompton Group, thanks for coming on today. I appreciate your time.
Thank you.
Up next, shares of Enbridge have closed down on Friday after the company's first quarter profit fell due to derivative losses and softer operating results. We'll get analyst reaction from Citigroup analyst Spiro Dounis next. Enbridge shares were trading lower on Friday despite exceeding first quarter earnings expectations. Our next guest maintained buy rating, citing a strong project backlog for the remainder of the year. And we got more from Spiro Dounis, director at Citi Research, on that.
We look at it from the EBITDA perspective, and on that front, they did surprise to the upside by about 2%. Big driver year over year, and some of the movements was on the FX side, on the foreign translation, and so that's why we're not too concerned about it. It's something that's a bit outside their control. But if you look at the underlying business fundamentals, we were really surprised on the gas side. That's really where we saw the strength in their business, and a lot of it had to do with winter weather. It was much colder. We saw a lot of draws out of storage as a result. And then you saw a lot of the white space on these pipelines really get filled up. And that's something that we don't really expect to slow down, even counter-seasonally here. We've got a lot of power demand driving the need for these pipelines and gas through these pipelines. Really, the only sort of weak spot we might have seen there was just on the liquid side, specifically when you sort of look to some of the U.S. Gulf Coast numbers that we found. It didn't meet the mark. However, the devil's in the details there. As we look forward, really only got 1 month of really strong benefit on the Gulf Coast. And a lot of that obviously had to do on the back of Iran, was a really strong draw for crude out of the Gulf Coast. And so going forward, we expect to actually for that to be a tailwind as well from here.
Okay, I just want to ask about gas, because you mentioned the winter weather, of course, meant a lot more reuse, and that was a positive for them. But if in the summer you're expecting it to be the same, what are you basing that on?
Yeah, so obviously you're going to have a typical seasonal slowdown, and we model that, and I think people are well aware of a typical sort of dip in these shoulder months here. But as we think about the broader thematic around natural gas demand, you look at some of the top 50 pipelines in North America, they're running at about 90% full in any given day. And so that rubber band is really being stretched. And so if you do have maintenance and supply outages, it tends to really spike the demand for some of these pipelines. And so as we think on the go-forward basis, once again, the theme of power demand, data centers, AI-driven data center power demand is all keeping these pipelines very full. So sure, we will definitely see the seasonal slowdown. That's pretty normal, but I'd say the fundamentals underlying that are really strong still.
Okay, they've added to their backlog, now at $40 billion. What are the additions that are helping them there?
Yeah, so a few. So they've added kind of across the spectrum, and that's kind of what we like about Enbridge is you don't have to choose one commodity or the other. They're really hitting it on every different commodity group here. If you need more energy, you need more of what Enbridge has to sort of offer. And so as we think about what they added, adding some crude projects on the mainline side, adding some renewable projects on the U.S. side, and then also adding some gas and transmission projects, Vector being the big one up near Ohio. So kind of giving you a little bit of everything. You're right, they did increase the backlog to about $40 billion. If we think about what that means, it's about 4 years worth of capital spending. They spend about $10 billion a year on projects. So really great visibility over the next few years. I guess what's more interesting beyond that is they expect to announce another $10 to $20 billion over the next 24 months. And so really growing that backlog. And then what we don't see is another $50 billion of projects sitting behind all this that could eventually make its way forward.
Why do you think shares are lower today then?
Yeah, it's been a really tricky tape. I think if we have to look at what's really driving a lot of these stocks, there's two things other than the actual results themselves. Obviously, one would be Middle East headlines, of course, drives a lot of the reaction any given day. I don't know that was it today. I think today was really more about positioning. If we think about the setup into a lot of these earnings prints, especially for the energy names, expectations are high. You've got really high commodity prices. You've got a good reason to believe that volume flows have been strong. But I think we've got to keep in mind for this first quarter, you're really only getting about 1 month of that benefit, of course, in March. And so I think expectations are pretty elevated. And we've seen from a lot of their peers, big gas beats and raises. And of course, with Enbridge, not nearly as direct commodity exposed. And so we didn't expect that big of a beat on that front. But once again, just simply where the market starting point was, expectations were high. We think they largely delivered on that, delivered projects, beat on our earnings print actually, but just didn't outsize surprise us.
Okay, the executives at Enbridge say the macroeconomic landscape strongest in over a decade. You talked about Iran being a part of that. How much of that is nation building?
Yeah, no, so part of it's really just about the supply disruption that's going to linger really beyond the near term, right? I think if you look at what a lot's being said around the sort of crude and supply disruption, you really got to go and backfill a lot of these inventories on the crude side that's been lost. And so this is probably going to take over a year to kind of correct on the other end. And for that reason, you're seeing a big draw from North American oil and gas. And so I think that's part of what they're talking about is all this interest to export more crude out of the U.S. and obviously from Canada down to the U.S. and out again. And I think as long as that's in place, the fundamentals look strong for the next year and a half. Even as you go to the natural gas side, I think you can make the same argument there. U.S. LNG and Canadian LNG is now needed more than ever, viewed as a stable source of supply. And so in that backdrop, we would expect there to be a lot of infrastructure build out to support what could be a new wave of demand on the back of this.
Okay, are there headwinds you see for Enbridge? One of them possibly being competition in the U.S., of course, to get things built?
I wouldn't say there's any obvious competition that hasn't been there before. If we think about it, still the large set of players that they're competing against. And I guess what's interesting on the pipeline side is it's very regional, right? And so I think you're going to see them compete just about as good as anybody else for those wins. I think their pipelines are really well situated in very close proximity to power plants and very close proximity to data centers. And ultimately, they've got pretty critical assets across the board when we think about the big themes, right? And those big themes, of course, once again, are data centers. We think they've got the right pipelines in the right place on that front. We think about LNG. They connect into all the U.S. LNG facilities and also have an LNG interest in Canada. And then if we think about the crude side, they are roughly 2/3 of the egress on crude out of Canada. And then, of course, have a massive position on crude egress in the Permian, which is the premier basin in the U.S., as well as an export dock out of Corpus Christi. That is where most of the exports are going. So we think they've got all the right assets in the right places. No reason they can't compete.
That was Spiro Dunis, director at Citi Research. Coming up, the latest on the setback facing farmers in Saskatchewan this planting season due to severe flooding in the province. That's next. Stay with us. Some farmers are back in their fields in many parts of the prairies, busy planting this year's crop. But for others in flood zones across Saskatchewan, it could take weeks before they start seeding. Another setback as producers already struggle with the high cost of fuel and fertilizer. CTV's Alison Bamford has more on the triple threat.
A lakeside view that would almost be serene if it wasn't in the middle of the Hoey family's field.
This was technically pretty much all seeded last year.
Normally, Joel Hoey would be in the field by now, planting this year's crops. But floodwaters are pushing back his timeline at least 2 to 3 weeks.
We're not anywhere close. It is what it is, but at the same time, it's really just starting to eat away at your bottom line.
Last year, this entire field was wheat. Hoey and his family were hoping to plant peas here this year. Likely not going to happen now unless all of this water recedes in a hurry.
Rising price of fuel, the high cost of inputs, and then you got this situation that we have starting later. It's a real kind of a bummer.
The area and dozens of others are under states of emergency, leading to seeding delays across the province.
Later seeding just will likely translate into lower yields.
That is, if some crops are seeded at all. Farmers have until mid-June to plant their crops in order for them to be covered under insurance.
I'm pretty sure there's going to be quite a few acres going unseeded this spring just because they're just too wet to get into in a timely basis.
Even when things dry up, flood-damaged roads will make it hard to get heavy equipment anywhere. But there's reassurance from Saskatchewan's agriculture minister that road repairs will be a priority.
We're going to try and work as quickly as we can. Obviously, you got to wait till the water's gone.
It's not the start Hoey wanted, but he's not writing off the year just yet.
We're doing all our due diligence to get everything ready to go.
Hoping for a smooth season once seeding gets underway. Alison Bamford, CTV News, near Paddockwood, Saskatchewan.
Coming up, we are watching shares of Doman Building Materials this morning after the company posted better than expected profit. And we will talk to the CEO when we come back. Stay with us. Shares of CAE are down as the flight simulator maker says it is seeking strategic alternatives for Flightscape. That's its aviation software business, which helps airlines manage their operations. The company says it will assess a full range of options, including a possible sale of the business. Last month, CAE said it was laying off 2% of its workforce and launching a review of operations at 3 training centers in Brussels, Stockholm, and Barcelona. And shares of Barrick are up as the mining company beat estimates on profit and revenue in its latest quarter. The mining company was helped by higher gold prices and improving operational performance, with free cash flow also climbing sharply. Barrick also announced a $3 billion share buyback ahead of the planned IPO of its North American assets. And shares of Mosaic are down today. The American fertilizer maker withdrew its forecast for annual phosphate production and says it will curtail output at some facilities due to higher costs. Mosaic has also taken steps to partially curtail production at 2 facilities in the U.S. and scale back additional production in Brazil. And we are watching North American markets this morning. The TSX up by 0.5% to start the week. S&P also up. The NASDAQ down, though, at the moment. Continuing to watch this. Everything happening in the Middle East obviously affecting what we're seeing here. Also watching the price of oil. Oil climbing as the Strait of Hormuz remains shut today. Brent advancing as much as 4.6% this morning. And we're seeing oil, obviously, now. It is rising by almost 2%. And on the flip side, we're also watching gold. As oil rises, gold was falling earlier today. It's up 0.1% at the moment. But earlier this morning, it was falling as Tehran said the U.S. continues to have unreasonable demands. The latest from the Middle East seems to be fanning inflation fears here at home as the two sides seem unable to come to some kind of agreement to open the Strait of Hormuz. Obviously, President Donald Trump potentially hoping that could happen before his trip to China, which is on Thursday. And we're also watching the loonie. It was pretty flat this morning as higher oil prices steady the currency. And Bitcoin is another one we are watching closely today. It was stalling earlier this morning. Bitcoin was. Smaller cryptocurrencies were gaining, though, as investors look ahead to a bill that would regulate the crypto industry. Bitcoin up by 0.1 at the moment. It was just above 81,000, now just above 80,000. Still ahead, we are watching shares of Doman Building Materials this morning after the company posted better than expected profit, and we will talk to the CEO when we come back. Stay with us. Doman Building Materials posted an EBITDA beat in the first quarter despite lower pricing for plywood, softwood lumber, and engineered wood. The company says Doman's focus on cost management is allowing the company to navigate these volatile macro trends. So here to tell us more is the CEO of Doman Building Materials, Amar Doman. It's great to have you join us. Thanks so much.
Thanks for having me on.
So a beat in EBITDA this first quarter. What's behind that?
Yeah, a few things factored in. Number one, the volumes were not as bad despite the tough weather we had all over North America. I mean, that's kind of normal, but it was a little more severe. But having said that, we had a little bit of a push in the south on U.S. pricing. Our cost control and discipline was excellent. The Canadian lumber market's very, very tough with the non-tariff lumber competing for a home, if you will. So that put a damper on that side, as you mentioned, on the OSB, plywood, and Canadian lumber. The U.S. gave us a little bit of a push towards the end of that, sort of the third month in the quarter, and that gave us a little push as well. The gross margins were super strong for us coming out of the gates in the first quarter, so very proud of a strong first quarter for the company.
You mentioned kind of your strategy for navigating these kind of volatile prices when it comes to plywood, softwood lumber, engineered wood. Can you go into a little more detail at what that looked like?
I sure can. So, a few things that happened. The lumber market, was quite poor last year. We produced about 2.7 billion feet, which is a ton of pressure treated lumber for the backyard category in North America. We sell retailers and pro dealers, et cetera. So what happened last year, the lumber market was quite poor as it kind of went along during the year. We've got some very seasoned buyers in our company, so we were loading up a lot of lumber to get ready for the spring season, as we normally do. We went a little bit heavier due to the pricing being poor, and some of that reflection came back to us here in the first quarter as we saw pricing improve, and we got to take advantage of that. So our timing worked out very well.
You mentioned off the top something about the non-tariff Canadian lumber. How exposed are you, I'm wondering, to U.S. softwood lumber tariffs?
Yeah, the good news with Doman is we're not exposed at all. Maybe 1% of our lumber goes across the line. But in Canada, the lumber market is very poor. The Canadian sawmills are in tough shape, and they're, competing for Canadian business, which is non-tariff, because of course everything that goes over the border is a severe tariff and duty on it. So that makes the Canadian market a bit of an auction, and that's been tougher for us on our margins. Volumes haven't been terrible in Canada, obviously coming out of winter, but it's the margin that's been a different story.
Some analysts see your freight optimization technology and increased fencing production as key drivers of organic growth and margin improvement going forward. Can you tell us how you plan to kind of use these segments of your business to offset any other volatility that you're seeing?
Yeah, we're doing the best we can with the freight issue. Of course, we try to pass along the best we can. We can't pass along everything to our customers. It's a line item for us. It costs, X to go from A to B. If it costs X plus 20, we've got to charge the 20. But of course, we get pushback from our customers, and we have to work through that. So we're doing the best we can. We've had some good freight recovery start to happen kind of mid-March into April, so into Q2 here, where the customers realize it's a reality. Looks like, the Iran thing's anyone's guess, but it's not going away anytime soon. So we need to charge those freight surcharges and have them recovered such that they don't damage our margins. And as you can see, we did okay with that in the first quarter. More of that was good buying of lumber, but certainly we're trying to recover the best we can. And also our freight optimization, we're rolling out software across the United States. We're about 75% US in revenue now. So we're really trying to get our freight optimization strategies into all of our branches, where we're going to see our freight costs continue to go down through efficiencies, through finding trucks in different regions and really scrutinizing that. But although trucking has become tougher and tougher in the United States, due to a lot of drivers, kind of going away, if you will, and it's been harder and harder. So we're trying to manage that the best we can.
Interesting. I want to talk about Prime Minister Mark Carney's announcement last month about a $6 billion plan to train 100,000 skilled workers over the next 5 years. How much of a meaningful impact do you think this will have on the industry, the sector as a whole, as well as your company?
Yeah, I feel for those workers, and I hope they get retrained. I think there's been a lot of press releases over the last decade, and I haven't seen a lot really materialize from some of these large announcements. I'd rather just see the government help us, in the industry, or help the industry of the workers with some base hits, not these grandiose plans that don't seem to materialize. Let's hope they do. That would be good for, Canada in general. Let's hope some of these press releases come to fruition.
Okay, so but if it was to come to fruition, that would be a meaningful impact for your business to have more of these skilled trade workers?
It would, absolutely. I think for us and really the construction industry, one level kind of away from us, where the nail hits the wood, if you will. Mm-hmm. I think that area, the trained workers that would come out of the sawmills that have closed, sadly, in Canada, are looking for, long-term work. And I think that sector would definitely benefit if they're retrained.
Looking ahead, does Doman Building Materials have any plans for M&A on the horizon?
We do, and we've grown through acquisition. We've completed 17 since 2009. We'll continue on the acquisition trail, mostly in the United States, a little bit left in Canada to do in our sector. When the right valuation comes to play, we will certainly look at buying those businesses. We're very, very serious acquirers, and we will continue to buy businesses that make sense, fit in to our fold, and allow us to leverage volume. The bigger we get, the better the margins will start to happen because of those operational efficiencies as we continue to grow our footprint in North America.
Oh, that's what I wanted to ask you. What about growing your footprint throughout the U.S.? What do those plans look like?
Yeah, so we're pretty much from Hawaii all the way to the East Coast, down to the Carolinas. The areas we're not in are the U.S. Northeast in any significant way, Florida, and again, two high volume regions that we'd like to get into, will get into when the right transaction comes in, or we'll greenfield. And then in the West, Colorado, Utah, that's an area that we would like to be in, and we will be in, just a matter of time.
Okay, we'll leave it there. Amar Doman, CEO of Doman Building Materials. Thanks for your time.
Appreciate you having me. Thank you.
Thank you. Okay, it's time now for Hot Picks, and today we are zeroing in on the biotech sector. Our next guest is highlighting a California-based company developing cancer treatment. So let's welcome in David Nierengarten, Senior Analyst at Wedbush. Hi, good morning. Great to have you.
Hi, good morning.
Before we get into your hot picks, just kind of an overall look at this sector. Biotech stocks kind of rebounding over the last year or so. Can you tell me what the sector and the industry kind of looks like at this point?
Yeah, it's been a great past 12 months or so, really, with additional acquisitions, a tick up in M&A that's really, I think, given a tailwind to the market here. And furthermore, some well-received recent offerings, both follow-ons and IPOs, have, I think, restored some confidence in the investor group that, we have some continued outperformance here.
Why was there a lack of confidence before?
I think it was a tail end of the, declines post-COVID. I think that M&A previously had disappointed, along with, some of those, follow-on and IPO offerings. And, just kind of the negative momentum, continued to, spiral there. Never mind the volatility in FDA, decisions, along with some challenges in interpreting what was going to happen with both the FDA and tariffs and other, regulatory actions going on when the administration changed.
Understood. Okay, so let's get into it then. Your first hot pick, Nuvation Bio, trading on the New York Stock Exchange. Tell us more about this company and why you like it.
Yeah, so Nuvation it's first of all, it's well off its highs. So I think, you're getting a little bit more of a value here, but what they are doing is marketing a drug called Ibtrozi in a subset of lung cancer patients who have a particular mutation called ROS1. They've launched a drug last year in the third quarter, and in my opinion, the sales have done reasonably well. And importantly, the underlying trend here is the increase in number of patients who are being treated in the frontline setting, right away. Those patients can be on therapy for 4+ years. And I think the market is underestimating how that's going to, stack over several years into the launch as those patients remain on therapy, plus new patients come on board.
Next up is Spire Therapeutics. Tell us more about this one and why this is one of your picks for today.
Yeah, so Spire Therapeutics it's really cool autoimmune focused company. They have data coming up for several of their programs, called TL1A, and another program in rheumatoid arthritis. So they're looking at both irritable bowel syndrome and rheumatoid arthritis. Those data will be coming out mid this year and into the second half of this year. So they have several catalysts coming up. And their previous data that they did show for a different program, but using the same kind of technology that they're developing to extend these therapies, half-life in the body, that looked really good with high exposure and good responses for that program. So I think that these next programs will also have a good benefit for patients, and the data's coming up. So folks should take a look and take a look at the programs.
You say you feel the market is undervaluing this company's opportunity in rheumatoid arthritis. Why is that?
Yeah, because I think the focus has been from the company's establishment in irritable bowel disease. And so, I think there's just a bit of a lag effect here that people haven't appreciated the opportunity here in rheumatoid arthritis. They haven't appreciated that, this is a little bit of a newer target in rheumatoid arthritis, this TL1A target. And so I think they're, maybe staying on the sidelines a bit to see if the mechanism proves out. But if the mechanism proves out, they're going to be too late, frankly, because the stock should rally quite nicely if the data are positive. So, there's scientific reasons to believe that it should work in rheumatoid arthritis. And, I think the stock, again, will react favorably when those data come out and the street, doesn't appreciate it at the current moment.
Okay, last up, Perspective Therapeutics. Tell us more about this one.
Yeah, this is a little bit of a complicated story, but it's a radiopharmaceutical company. They are developing a newer isotope in radiation, therapy for cancer treatments called lead-212. They've had good data in a subset of tumors called neuroendocrine tumors, relatively uncommon, but they're well treated by their therapy with lead-212. And then they have a couple other programs, again, coming out later this year, one in melanoma and one in tumors that have what's called FAP, as a marker. And those are new programs, and hopefully those data will be positive in the second half of the year. And again, prove out the point that lead-212 is a viable isotope to use in radiation oncology.
Just in our last minute here, what do you think some of the biggest headwinds are for these companies that you picked today, as well as the biotech sector as a whole, like some of the biggest challenges?
Yeah, so for Nuvation, for example, that's a little bit different. They have a commercial product, so any headwind is going to be launch related. For the other programs, it's going to be data related. Generally speaking, for the industry, a headwind would be we've had a nice uptick in M&A. If pharma companies pull back from their acquisition trends, then that could reduce enthusiasm around the sector. So that's one of the things to watch. Another thing would be changes in the regulatory regime yet again, causing volatility or changes in investors assessments of probability of regulatory success.
Okay, we'll have to leave it there. David Nierengarten, Senior Analyst at Wedbush. Thanks for your time. Appreciate you joining us.
Thanks.
Coming up, we will look at some of the stocks on the move on Bay and Wall Street, and we'll take you behind the scenes of the Met's new fashion archives and exhibit. Stay with us. That's next. The Met Gala is the museum's biggest annual fundraiser this year, raising $42 million to help fund exhibits, pay curators, and preserve paintings, sculptures, and one of the largest fashion archives in the world. For more, Bloomberg The Weekend was the first to see the exhibit and the new gallery in a private tour with Met director and CEO Max Hollein. Take a look.
We love you. Oh my gosh! Beyonce! Sam, is this Erte? Is it Erte?
Before the couture and the chaos,
it is always a very exciting moment. It's a big celebration for creativity, for the arts, for fashion, for New York City, and certainly also for the museum.
Met Director Max Holein met us on a Wednesday in a closed museum to show us what they've been working on.
What is the lead time to developing an exhibit like this? Is it year by year, or are you looking many years ahead?
So it took us 8 years to get this show together. It wasn't that we were thinking about 8 years, how do we do it, but really to get all these important loans to one place, that's really the challenge. So the preparation for these shows usually take more like, 2 years. And importantly about this exhibition, it's only Met collection. So
you don't have any loans. This is all your in-house.
All from the Met's collection. The Met actually is one of the biggest and most profound collections of fashion. So we have 37,000 garments here. Fashion is not only one of the really complex ways of expressing human creativity, it's also something that basically is so attuned to the current time, but it is also something very difficult to collect.
It's very perishable, right?
It's perishable. It takes up a lot of space. The Met Gala provides the funds that are necessary to run a department, to run a collection, really also ample service of preservation of fashion history for our communities.
Can we go take a look?
Please, come.
Like everywhere in Manhattan, real estate is at a premium. The museum can't expand anymore into Central Park, so it has to find creative ways to carve out new gallery space within the pre-existing footprint.
This was the retail store.
This is the gift shop.
Yeah, this was the gift shop. So now enter through the gift shop, but we actually changed the gift shop into grand exhibition galleries. So you're the first ones to see the new galleries of the Met. These are all objects from the Met's collection. It's a show that's like a manifesto. It's called Costume Art. And what it tells you is the story of the importance of the dressed body, of fashion in art history. So on the one hand, you see fantastic costumes, but on the other hand, you also see how all the other artworks in our museum, and how on the other hand also other art influences fashion and vice versa.
But fashion can also be kind of political, right?
Of course, it's always also a statement of expression, of power. Fashion is so fascinating because it's probably the art form that kind of responds so immediately to our current time.
I imagine it's unique in that you have curators from different expertise is working together in a way that they probably wouldn't otherwise, that you would have.
We have 140 curators working here. Everyone is very specialized in their area. And so we need to create more opportunities for them and for our different areas to be in dialogue, in conversation. And we want to have one inspire the other.
David, this is menswear.
Yes,
you could wear that on set.
Well, you should take inspiration of this. No, not only what you want to look at, but yes, what you need to wear, right?
I'm going to push him sartorially, and I'm going to tell him it's art, so he has to do it.
Indeed.
But the Costume Institute is only a small piece of the bigger picture. After struggling to survive COVID and the resulting hit to both patrons and patronage, last year the Met had its highest attendance since 2019.
And we have 6.3 million visitors a year. Wow. We are currently undergoing a total kind of overhaul of about a quarter of our entire gallery system.
You're the director, you're the CEO as well, and I'm curious, when it comes to benefactors, is there more reluctance now because of the broader cultural undertones that we have, or
just the economy?
Yeah, are people less willing to give or to engage?
So we've seen quite the opposite. I think you see this museum being enormously supported, of course, by philanthropy. So I think that there are various ways that this museum serves its audiences, its communities, and I think broader purposes that we all care about, no matter where you are on the political spectrum.
That means investing $1.5 billion over the next decade, building out new galleries and exhibits to be more inclusive across genres, geography, and time.
It is very important to not have, so to say, only Greek and Roman and European front and center, but really apply the same care, apply the same grandeur, the same rigor to also all the other areas.
Placing a bust from northern Pakistan next to an old European master, and displaying a Congolese power figure not as an ethnographic artifact, but as a significant work unto itself.
I think it's also important to see that we sometimes walk through these galleries and think that this is like archaeology, but a lot of this is contemporary art.
Can you just speak to what you have in store with the museum here over the next decade or so?
So we reopened the European Paintings Galleries. We reopened the Rockefeller Wing just last year. We will open the new Costume Institute Galleries in couple of days. Yes. Next year, we will reopen our ancient West Asia galleries, and then also our new wing for modern and contemporary art. That alone is a massive project, construction of about $600 million.
Is the new footprint of the museum, are you trying to get people to have those conversations in real time as they move through the museum?
That's exactly right. So the whole museum becomes, in that way, more fluid. We really show how, in that sense, African art is so connected to European art in that context, etc.
Who are those who are coming to the Met Museum in the year 2026?
Our average age currently is 35. We have people from the very young age to the end of their life, but it basically shows you the diversity of our audience, and our local visitorship is enormously strong. And then, of course, domestic and international tourism.
Last Monday's gala raised $42 million to help fund not just the Costume Institute, but museum programming and activities for all its visitors, no matter what they wear.
Why was now a good time for a statement about the importance of fashion?
I think that fashion has been part of the Met's history and the Met's institution for such a long time. It responds very quickly to what's going on in the world, how contemporary culture feels these days. So it's actually sometimes faster and more immediate than painting, sculpture, drawing, and I love that.
Okay, we'll take a quick look at the markets before we wrap up here, starting with the TSX, which saw some gains on Friday, hoping to continue those gains today, up above 34,000 points at the moment, above 0.4%. If we look at some companies on the TSX, Barrick Mining reported we're also watching Shopify. It's up almost 4% at the moment, down more than 4%. Barrick Mining is another one we're watching. It reported first quarter gold production posting a drop in profit in the first quarter compared to the previous quarter. This is a Toronto-based company, obviously, and it has also authorized the repurchase of as much as $3 billion worth of its shares. Seems as though investors feeling optimistic, a little more confident on that note. Barrick Mining up this morning more than 7%. If we take a look at U.S. markets, stocks seem to be wavering a bit given what's happening in the Middle East. They're up right now, ever so slightly. S&P 500 up by 0.2%. The Dow Jones basically unchanged. The Nasdaq also basically unchanged. Some interesting news, though, coming out of the U.S. Beazer Homes. We're watching this company pretty closely today. Wow, it's up 31% over the last year. Dreamfinders is proposing to acquire Beazer Homes for $704 million. Dreamfinders says it believes the two companies would drive more affordability to home building customers. And so we're continuing to watch the price of Beazer Homes US today to see how that factors in. Also watching the price of oil. It is climbing as the Strait of Hormuz remains shut. It's up more than 2% at the moment. Brent this morning advancing as much as 4.6%. So we're seeing oil on the rise again. On the flip side, gold is falling, or it was earlier today. It seems to be relatively flat at the moment. Yeah, it's up by 0.1% right now. But this comes as Tehran says the U.S. continues to have unreasonable demands. The latest from the Middle East seems to be fanning inflation fears there, as investors really not sure what's going to happen, when this conflict could potentially end, and when the Strait of Hormuz could potentially reopen fully again. That wraps up this edition of The Open. Morning Markets with Roger Peterson is next. Stay with us.